Hello, everyone. How's it going? I'm Scott Welsh. We're going to talk about something that is a little bit controversial. I'm saying that up front. Some people get very, very passionate about this subject, but I'm just here to give you some information. I'm just here to help you out with your trading. I'm going to give you a bunch of numbers, a bunch of information. I'm going to give you something that you can use. But that specific controversial topic we're talking about is risk to reward. All right. So here's your disclaimer, by the way. Like I said, I'm going to talk about a lot of numbers. These are hypothetical numbers. They're just here for entertainment. Please don't risk anything that you can't afford to lose. You know that by now, but I need to say it because we're going to talk about a lot of fun information. Now, these things today, as I have four things on the screen, but the first one is very, very important. I don't have anything to sell you today. I don't know if that's a problem. I don't know if you came here to buy something, but I don't have anything for you to buy. There are two things I like. Number one is I love trading, but specifically, I love research. I love it. It is a good time for me on a Friday night to sit down with some charts and do some research. I love it so much. But the other thing I love is our stories about traders who make money. I really, really like that. Trading is hard, right? What are the stats? Is it 85% of traders fail? Is it 90? Is it 95%? Whatever it is, it's far too high. Trading is awesome. It can change lives. And it's about time we work together and stop this nonsense of everybody failing, right? That is really, really important to me. I was formerly, in my previous life, a high performance tennis coach. My point as a high performance tennis coach was I wanted to prove that anyone could turn pro and get a world ranking. That was my passion back in those days. And after five students turned pro and got their world ranking, I think I proved my point. So that's just 2-second background on me. And it's point number one. I would love it if you take any information from me at any point and email me and say, I made money doing XYZ. That would be awesome. So that's point number one. But the three things specifically we're going to talk about today are the fact that a good risk to reward ratio is the holy grail on paper, right? That's in parentheses, but it is the holy grail. We're going to talk about that. We're going to talk about what a bad risk to reward ratio is and how we probably don't want it, or maybe we do want it. And can a bad risk to reward ratio beat the market? Okay. Now, we've all been told, you've been on webinars like the one we're doing right now. You've been told that there is no holy grail. I've read it myself many, many times. There is no holy grail. We're all kind of immune to it. But the problem is there is a holy grail. There is, but it's not a system, not a special indicator. It's not a secret methodology, right? The grail is risk to reward / money management, right? Systems aren't that important. Now, I just said I love research, and I do. I love researching systems. I love talking about systems. I love it when other people talk about systems. I love it. But truly, they're not important, right? If they were, then only one or two people on earth would be making money, right? If the system mattered, then we'd all have to trade one or two things, except it doesn't matter, right? Because so many people do so many different things. So you can trade this way and that person can trade that way and everybody can make money. You can be on the 1-minute chart, they can be on the weekly chart, and we all can make money. See what I'm saying? The actual system isn't important, as much as I love it, but money management is. If we risk too much and have a great system, we lose. If we risk the right amount with a mediocre system, we win, right? So money management is the holy grail, and the pinnacle of money management to me is risk to reward. According to smart people who have done trading for decades, we've learned, we should know, that we always want to risk less than we profit. We want to put $100 on and we want to make 500, right? That is the magic. Paul Tudor Jones, one of the most famous names in trading, has told us many times, as long as we're willing to listen and look and read or listen to what he has to say, our profit on a trade should be 5 times bigger than the risk. And if it's not, we pass. We do not even take that trade. Whatever it is, investment, real estate trading, doesn't matter. Don't take a trade unless your risk to reward is positive. And he specifically says 5 times bigger than the risk. Now, Tony Robbins, who's notoriously famous, not notoriously in a bad way, notoriously in a good way, famous about all of the amazing stuff he's done, but specifically, he wrote 2 books about money. He wanted to help the regular person make money. And guess what Tony Robbins echoes over and over again in his 2 books, Money and Unbreakable? Well, he interviews and quotes Paul Tudor Jones and says the same thing. Our risk to reward has to be positive, meaning our profit's bigger than our risk. And he talks about Paul Tudor Jones and says that exact same thing, 5 times bigger than the risk. And that makes sense, right? If we make more than we risk, we really don't have to worry about losing at all, right? Because one win cleans up all of our stupidity. If we lose and lose and lose, that's 3 losers in a row. And in our example, let's say we lose $100, $100, $200, $300, and then we win. Well, if that's 500, 5 to 1, I mean, that's pretty easy math, right? One win gets rid of all the losses. And again, that's the Grail. Furthermore, and here's the magic part, when we add in, if we could just win 50% of the time, which isn't a lot, right? It doesn't seem like a lot to ask. If we could just flip a coin, and when we're right, we get 5 to 1 on our profit compared to our risk, then we're all set. I mean, we are all set for life. We never have to worry about trading paying our bills or trading bringing home the bacon. It's already brought home. Our risk to reward takes care of that, right? But even less than that, less than what Paul Tudor Jones said, if we can win half the time, 50%, and just make 2 times the profit as we do risk, right? So 2 times profit over risk, that is an unbeatable scenario. So we're all set. The webinar, no, we're not done. We have a problem. No automated mechanical system exists on Earth that has that combination. That's the problem, okay? Now I'm talking about a closed-end system. I'm talking about a system that anyone could run. I'm talking about a system that I give you some rules and you go trade it. Now, I've been researching systems since 2004. I've been a discretionary trader first, of course, most of us are, but I've been investigating robots since 2012, so it's been a while. We're talking hundreds and thousands of hours researching systems. And I like trading systems. Get in here, get out there. And I trade automated systems. Get in here, get out there. The software does it for you. So I've spent my time researching it, all right? I didn't start doing this yesterday. And I have found exactly 0 systems, automated, mechanical, that have those 2 combinations, that 50% win rate and then a positive risk to reward. Now, this is not to say, right, this controversial part, right? I'm not commenting on discretionary traders. It is very possible with a discretionary trading system that there are traders out there that can make that positive risk to reward, right, and make 50% or more. I'm not saying that, but 2 problems with that. How would we prove it, right? If someone says, well, I made it and I took this trade and I got out here and I did this, well, prove it, right? Well, maybe they could prove it. They could give us their trades, I guess, but I mean, it was discretionary, right? How did you get out? Why did you get out? But actually, more important than that is, how do you and I profit from that? How do we get better, right? He got out or she got out here and got out there, and that was his or her special rule. And well, I don't know how to do that. So how is that useful to me? How is a discretionary system useful to me? if I can't do it exactly like he or she can? You see my problem? That's why I love automated systems. Because if there's an automated system that works with hard rules that aren't discretionary, I can trade it tomorrow and you can trade it tomorrow, right? We can actually spread the word on a system that might make money, but it's got to be hard and fast rules. So discretionary, you might be able to do it. I have no comments on that. That's not what we're talking about today. But what I am telling you, I've literally never seen it in my life. Doesn't mean I won't see it tomorrow. I might. I love the research, might see it. But that doesn't exist to date. It's always one or the other, right? Now, okay, let's be very clear. We can have our 5-to-1, right? Trend following systems. I love trend following. I've built trend following systems. And you can get profits at different times, right? In trend following, you don't really know where you're going with your profit, right? You just let it run. But you can easily get a 5x, right? Profit greater than risk. Absolutely, right? And trend following itself is based on the premise of our wins, hopefully, are bigger than our losses, okay? We can have that. So I'm not saying it's impossible. I've seen automated systems that have that 5-to-1, absolutely. But the problem is we can't have a greater than 50% win rate. That's the problem. A trend following system or an automated system or a system with rules cannot have 50% and the positive, right? So what are we left with, right? We know it's the Holy Grail and we can't get there. So what are we left with? Well, we're left with a bad, quote unquote, see that in quotes, a bad risk to reward ratio. Oh, great. Now we can't win, right? Now we're all failures. Well, is it really bad though? All right, let's find out. Let's dig into this for a moment, shall we? I wanted to look at the ES, okay? I know that there are a million other instruments, but I'm just talking about the futures contract ES. I love the ES. Why? Because it's an index, S&P 500 index. So I like that because an index gives us a whole bunch of diversification in one little instrument, which is awesome. Plus, futures contract has leverage, which is awesome. I know people tell you leverage is bad. I beg to differ. Leverage is awesome, but that's beside the point, okay? I just like the ES, right? I study a whole bunch of stuff. Email me, we can talk about another instrument, but we're talking about the ES today. Got it? All right. We're going to look into this good risk to reward ratio on the ES. Now, we're going to use a familiar off-the-shelf indicator. I love indicators. I know they get a bad rep, but I love them. And I specifically love it when they're off the shelf, right? I love to just take an indicator, do no doctoring to it, put it on the screen and see if it makes money. It does. But anyway, we're going to, for today's example, we're going to talk about Keltner channels. Ever use them? They're like in every platform. Well, we're going to talk about it today. And we're going to use the channels for our entry, and we're going to use a daily chart, which is super easy, right? I'm not telling you that you need to get on the 5-minute chart or 15-minute chart and sit in front of a screen. This actually could be traded discretionarily pretty easy, but it has definite rules, okay? So we've got our ES, daily chart, Keltner channels. Let's look at a positive risk to reward. All right, guess what, everybody? You get a free trading system. Right? It doesn't cost you a darn thing. Screen here. These are the Keltner channels, okay? Midline, upper band, lower band. Great, right? Daily chart, ES, right? This is from 2018. When price, here's your system, ready? It's super complicated. You probably have to rewind this 10 times. When price closes above the Keltner channel, closes above, you place a buy order, one tick above the high. And that is it. That's our entry. Complicated, huh? Off-the-shelf indicators, right? Default settings. When it closes above, place your buy order one tick above and you're in. You can see that the robot on the screen took this fake trade, right? This is just a hypothetical trade, and it went on his business, okay? So that's your entry, right? That's from 2018, all right? That's your entry, super easy. Now, I wanted a profit target, right? We're talking about risk to reward. So I tested for a high risk, right? A high risk to reward ratio. I wanted to make more than I was risking. Now, we heard about Paul Tudor Jones in the 5. I've heard what I would consider credible presenters talk about 5 to 10 times the risk. I mean, I've heard that with my own ears. So I split the difference for this example. I said, all right, let's go for a profit target that's 7 times bigger than the risk. Okay, so that's what I did. Feltner channels, 20 years of testing. Here's the report. All right. Again, this is one contract per time. You can trade as much as you want. I used a hypothetical about $6,200 account. Again, this is just hypothetical information, not real trades I took. Total net profit over 20 years is 18 grand. Yeah, I mean, it's okay. Profit factor 1.25, but you check it out. Our average winning trade, 3,800. Average losing trade, 500. That's about 7 to 1. So we did it. We did a positive risk reward. There's your max drawdown down at the bottom, right? There's your information. Now, I love to talk about return on account. I love that to evaluate systems. So the return on account was 137, but the return on that initial capital, if I use the hypothetical, $6,200 account, that was the return. Now you can see that the return on account and the return on initial capital was higher than just buying and holding, right? So if you just bought and held somehow the ES all this time, trading this way with a positive risk reward, quote unquote, beat the market, right? For all intents and purposes, right? Over 20 years, it did okay. Haha, great, right? On one hand, right? I know it wasn't a ton of money, but on one hand, we've done what the experts wanted us to do. We've done what Paul Tudor Jones wanted us to do. He wanted us to have a big risk to reward, and our wins were 7 times bigger. On the other hand, did you happen to catch that though? I didn't point it out. Did you happen to look at the percent profitable? 15%. Oh my goodness. Could you trade? Honestly, I'd love to hear anyone who could trade profitably for 20 years and only win 15% of the time. I mean, that is crazy hard to do. And we'd have to trade at a 15% win rate with profits that aren't much more than drawdown. So we've done our positive risk to reward, but honestly, is this the best we can do? Well, let's just say, all right, we're just talking here, let's just say that we do the opposite extreme, all right? Let's not listen to the Holy Grail, not listen to what famous people tell us, and let's go for a horrible one. Wouldn't that be exciting? Let's do the exact opposite, okay? Well, I did that on the ES with the Kelvin channels, and here's the report, okay? Here's our profit, 12,000, that's less. Max drawdown, higher, that ain't great. But check out the percent profitable, 97% win rate, right? If we just put in our entry, put in our target, and put in our stop loss, we win 97% of the time. Phenomenal over 20 years, okay? Pretty amazing, right? And you can see our average winning trade was only 200 bucks, and our average losing trade was 5,400. That is going the wrong direction. Am I right? The return on account was 99%. I mean, it's positive, right? The return on initial capital was a decent number, but I would consider that not beating buy and hold, not beating the market, right? For all intents and purposes of our talk today. And again, the profit dropped and the max drawdown went up. We went the other way. We were bad traders, and we did get a 97% win rate. So if winning keeps you in the game, if winning matters to you, then maybe, honestly, this might be better for you, right? If you can't stand winning only 15%, it would be better to trade this and make less money because you might give up on the other one. Any system you give up on doesn't make money for you, right? So in that case, winning all the time might make you more money in the long run, but profit did decrease and max drawdown increase. So that's it. Is that the end of our discussion, right? Were the experts right? Positive risk to reward is the only way to go. Not so fast, okay? Let's go in between. Let's go a little Goldilocks down the middle. Because I love to test, I ran one, and this took literally hundreds of thousands of tests, right? I just got a brand new computer not long ago, and it took an hour, and it's pretty darn fast, okay? This was a long test. I ran it, and again, same entry, but I just ran it for profits and stop losses. That's it. That's what I ran it for in US dollars, okay? And I wanted to see what the quote-unquote best settings were, right? Because best is arbitrary. We could argue that, right? And I tested every single target and stop in $10 increments from $200 profit to a $6,000 $100,000 profit, right? That is over 300,000 combinations. You see why it took a while. Okay, now here's the time, right? You ready? This is our interactive portion of our show. What do you think came out as a quote unquote best? Was it a positive risk to reward or was it a negative risk to reward? And I know the anticipation is killing you. Here is a screenshot of the results, okay? And this was over 300,000. I took the top 17. Stop loss, the best one, was $5,400. So you get your entry and put your stop loss in, trading one contract. Remember, you put your stop loss at 5,400. You put your profit target at 3,400. Okay, that is the best combination after all of that madness. Well, wait a second. That's not right, right? I mean, if we should only be looking for positive risk to reward, if that truly is the holy grail, and it kind of is, right? I mean, it makes sense that it is. But if that's truly the holy grail for everything, not just discretionary trading, then the results on this particular test should show a positive risk to reward, right? I mean, this is a lot of tests. This is a lot of information. It should have shown a positive risk to reward, and it did not. Now, think about this. In the top 500 tests, you just saw a couple of them, right? Only 2 in the top 500 had a positive risk to reward. 2. 498 combinations were negative, 2 were positive, and oh, it wasn't 2 to 1, it was barely over 1 to 1. Think about that. The data says that the way to trade this is with a negative risk to reward. And here's the report. Using that stop loss and that profit target that we just showed, here is the performance report. $90,000 over 20 years. Whoa, does that blow your mind? Stuff like this is exciting to me. All right, now check out the average winning trade, $3,400. Just about what we plugged in, right? Average losing trade, $5,400. About, that's what we expected. Check out the percent profitable in that nice sweet spot range, right? I think we can keep coming to the charts if we're winning 77% of the time. Now, max drawdown did increase, but yeah, this increased huge, right? Take a look at our return on initial capital. We'll do it on the next slide anyway, right? And there it is, right? Our average monthly return, look at that. Return on account, high. I just like to look at this number, right? When I'm budgeting out or considering a system, I like to think, huh, this makes on the average $1,300 a month. I think that's cool. Anyway, if that's not important to you, then look at these numbers. Return on account, 372. It, for our intents and purposes, beat the market. It beat buy and hold. And the return on initial capital was through the roof, right? 1,400% with a negative risk to reward. So because the profits were so much higher and the drawdown only increased by double, but the profits increased by many, many times over, you can see that the returns are way better when you take everything into account, right? Now, just in case you're wondering, how'd the market do over the same time? Or here's your buy and hold. If you just bought it 20 years ago and somehow held it to now, you would have made 77, which is more than the others, but you also had to deal with a drawdown, max drawdown of 55 grand. So probably we'd lose our account. But assuming we didn't, right, trading one contract, those are about equal. You can see that negative risk to reward pretty much destroyed it. Is that interesting to you? Now, okay, fine. We did 7 to 1, right? And we did like negative, right? Are there other possible risk to reward ratios? Of course there are. Here are a couple. What if I just set it at 2 to 1, right? Well, we've got counter channel entry, profit, and winning trade is 34, average losing trade is 17, right? 2 to 1, 33,000, not bad, but max drawdown is still pretty high. It did not beat the negative risk to reward, right? Look at those numbers, right? Okay, well, what if I did 3 to 1? Well, then things started getting worse. Total profit at 10,000 and the max drawdown was negative 23. So 2 to 1 was kind of okay, 3-to-1 is terrible, right? Is that interesting? Time to wrap up. So here's the bottom line. A good risk to reward is great. If you can get it in your discretionary trading, then get it, okay? It is the holy grail. You are set for life, right? You don't need my approval. You don't need my my assent, right? You can be a trader right now. Good risk to reward, right? And 50%, you're set. But if you don't know how to do that discretionarily, and you can't copy exactly someone else who's doing it, and you want to trade a system because it's doable tomorrow, like I do, you've got to come to grips with the fact that those two don't exist. And there are many cases where a bad risk reward not only beats the market, but it absolutely destroys a good risk to reward. Okay. So that's your takeaway. You've got a couple things tonight. Number one, gave you a free system, right? You got your profit, you got your stop loss, you got your entry, right? So you got a free system, which is awesome. Go use it, make money, email me, right? The other takeaway is whatever you're trading now, if you are forcing a good risk to reward ratio, you might be missing out on a ton of profits, right? This is not the only example of a negative risk to reward. When you do the research, negative risk to reward is profitable on many systems, and it might be the thing you can put into your trading right now that can make you more successful. And that's your takeaway. All right. There's the email. Any success stories, please email me. If you're interested in information, I have an email list. I'd love to send you some information for free, stuff like this, right? I'd love to give you I'd love to share a bunch of my research. I would love to get an email from you someday and say, hey, I made money doing XYZ. So that'd be awesome. If you want to get on my email list, there's the website, go to scottwelsh.me, and there's my Twitter, follow that. Got a YouTube channel. I've been around doing that for a while, and also got a blog. So there's places to reach me. There's nothing for you to buy tonight. I just want you to make money trading.